Welcome to the Zacks Quarterly Market Strategy Conference Call, a service of Zacks Professional Services Division. In case you are a first-time attendee to these calls, this is a live conference call featuring Zacks strategists providing their analysis of the latest issues, trends affecting investors, the market, the economy, both globally and here in the U.S. Their analysis in this particular situation as best as they can provide given what's going on, and there's no shortage of stuff going on. Joining us as panelists today are Zacks Chief Equity Strategist and Economist John Blank. He is going to share his insights on the market and the economy in light of the current coronavirus chaos that's out there. Zacks Research Director Sheraz Mian is also with us, and he'll provide the lay of the land as it pertains to corporate earnings as best as he can at this point. And if you have any questions for either of them, don't be shy. Just type them into the message field at the right of your screen, and we will get to as many as we have time for. So, John, as we always do, let's start with you. The markets have become impossible to predict. And that's not an understatement. Well, maybe it is, with no apparent fundamentals under them. So given that, are there more questions than we have answers for?
Absolutely, Terry. Today, as usual, I'm going to stick with the ZRS charts. And as Terry referenced, the financial market is going to be our study today, not really the economy. So before I lean into the charts, as you can see here, is priced free cash flow. We're back down to 2016 levels. And you can see we're bouncing off that Christmas low around the same place. So first thing I want to point out to everybody, just look at this chart, just take a deep breath and realize one thing: this market's actually quite rational. And it's not pricing in anything more than a retraction of the last 4 or 5 years of valuations to cash flow that we saw a valuation at in 2016 during that earnings recession and oil price collapse back then. And it's really no different than the Christmas 2018 sell-off that we saw on recession fear. So again, a recession fear in late 2018 and a earnings recession in 2016, kind of the mix we have right now. And lo and behold, this is what you see is we're actually seeing a very rational pullback. Now, I'm going to show you just how rational this all is, because it's really kind of the story that nobody's telling you, and that I think is most interesting if we just stick to the facts on the markets themselves. Now, the economy, just so you know, when you shut down, the travel and the restaurants and the theaters and the sporting events, the amount of that you shut down is about 14% of the economy, 14% of consumption. So if you take 70% of the economy's consumption and multiply 14 times 0.7, you're going to get a number around 10%. And so when you see all these GDP forecasts for Q2 and Q3, they're going to be anywhere from -4 to -10%. And all that is, frankly, is how people are pricing in the amount of that closing. Now, for example, in California, yes, it is true you cannot have anything over 250 people gathering, but it's a recommendation for breweries, theaters, and restaurants to open or close. And in the smaller towns like I live in right now, they're actually open. There's nobody in them. Social distancing is taking on a role of its own. But it's in the big cities that the lockdowns are happening, and it's not happening out here. So that would, from an economist perspective, that's why you can get to a -5 or -6 GDP and not a -10. Now, does it matter at all to this market? Again, look at this market. The market's telling you, if you want to invert your thinking, that we're going back 5 or 6 years. In fact, we're not having an Armageddon. We're not in a 1929 scenario. I know people have said the pullbacks are 29-like. That is also being picked up here. You can see we went from a 35 to an 18 PE in 17 days. That is 1929-like. So really, it's getting rid of the euphoria and getting back to the other one. We just flipped over the last 20 years of the forward PE, And again, I did these last Friday, but notice again, if I do a forward P, not looking at cash flows because cash flows were enhanced by the tax cut, now we're back to a 2013, early 2014 period. Again, not like the debt crisis of 2011 at all. So that's the good news, that's bad news. I mean, this slide tells you where the next stop is in the technicals. We're at basically 15 on the forward PE, a little bit below that, 14.5. And during the 09-08 period, we got to 12. So that's another 25% from here. Now, do we do that? Remains to be seen. A lot of pessimism says, yes, we do. But you got to remember that the public health crisis we're in is attempting to resolve the coronavirus spread. And if it succeeds, then we all win at closing the economy down and we do pop back. So nobody wants to believe that, but today we got Abagan out of Fuji Films in Japan, which is a virus solution that's pretty effective. Regeneron has put together a cocktail that they think is going to work, and you can be rest assured that the entire world's medical community is putting in the yeoman's effort to get something in the way of a treatment, or if not a vaccine, probably not going to happen, but a treatment where you can keep people out of hospitals would do the job here. Because really what we're trying to avoid here is a massive health crisis. And what you're seeing with all the financials here is it's still fairly rational at this point in time. And I want to keep that in everybody's mind. Let's go to the next slide. Equity risk premiums, now about 7%. Again, 2011 was 8%. That's what I'm pointing out. We're not actually back to that 2011 period. You can see how much higher it got and how much longer it stuck around. It was for 3 years. So there's two ways to think about it. One is we're going to stagger around here for 3 years and get higher and worse. The other is we don't. And you can see the market's holding up at that 2016-ish area. We've actually been here before only 3 years ago. And this is what's interesting. The markets are being very rational, pricing basically more of a benchmark case than a worst case. A lot of the people out in the news are giving you that the market's going to worst case. Worst case is not this. This is base case with some mixture of hope. So we can get worse or better, but just keep in mind that right now this is not actually a very pessimistic market. Let's go to the next slide. VIX volatility. Again, from historic dimensions, we've never seen anything like this. Today I was at 70. A couple days ago it was 80, which is higher than 2008. So what we got here is, I think the linkages between prices and the VIX is actually there's a commingled cause. They're both being caused by the same thing that's linking them. What I think is happening is if the VIX explodes, the clearinghouses and the margin trading houses on stocks and futures, for example, the CME group, largest futures group, has now raised their clearing margins 150%. So that means you got to come up with the cash, which causes you to, they automatically sell other stuff in your account, which plunges the stocks down further, which raises the volatility higher, which brings them back to the clearing system. So it's kind of like the the old options pricing premium looking like the market because everybody's using the model. Here, the clearing systems models that are margining up people in their accounts are creating this spectacular move in cash creation. Nobody really expected this. It's coming so fast, and this is its own story. So the VIX is phenomenal, but I would point out today that BCA research, which I have a lot of respect for, has now put a call that if you have the stomach for risk and a long-term horizon, now is the time to buy stocks. And I do agree with that. Now is the time to buy stocks because this whole thing has happened. You got to have at least a 12 or 14-month window to do it, but you should be doing it if you have that window. And no, I did not move my asset allocation overweight stock market weight. You should keep your allocations in equities through this, because this is when, over an averaging perspective for the months ahead, people are going to get good prices in their stock accounts. So that's the thing people got to keep in mind is the market's giving you some good prices. And if you're not needing the money for over a year or two, this is the time to stick with your allocations. Let's go to the next slide. All right, profit margins and long-term debt. The basic thing I want to point out is these companies are very, very healthy. They've never had higher profit margins in this 20 years of history. And if you think we're in a position with too much debt to capital, like back in 07, 08, I would say, no, we're 20% low that. We're at 42, 44. We're up to 46, 48. So we're in a lot better shape. Companies are in a lot better shape. They can ride out things in a way that they couldn't ride out back in the 27 period. And I think that's particularly true for the banks. You have to remember, we did actually pass extremely adverse stress tests on the banks, and they all have to meet them. And this is certainly an extremely adverse scenario, and they are all prepared for it this time. So the banks are probably one of the better trades to make right now. For example, Wells Fargo, 7.5% dividend this morning. You got to say to yourself, really? Did we not learn our lesson? And because if we did learn our lesson from the banking perspective, those are buys, not sells. And that's what I'd like to keep everyone in mind. Next slide. All right, C&I loans over the last 15 years. This shows you the froth in the market. What you're seeing here is basically people aren't taking loans out, they're just letting the stock market run. This is what's going on also is a lot of the stock market is being pumped up by low interest rates and Fed liquidity. And in that Fed liquidity and low interest rates did not translate into excessive commercial industrial loans. So it is very unlikely that we have that blow up, which is good news. And I know we see the high yield spreads blowing out. That's basically the energy market. And so I reference my comments to something outside the energy market. Energy market, I would stay away from for at least a year because demand is not going to come back. And there is a supply issue between the Saudis and the Russians you've heard about. And that's unlikely to resolve, though it could. It's certainly better trades to be made than energy, and I would stay away from energy. Next slide. All right, Apple stock, last 20 years. All I want to point out is this looks pretty standard for Apple stock. I mean, it's done other pullbacks like this. And again, back in late 2018, before that Christmas sell-off, looks a lot like this. So the big mega cap stocks, probably not worth taking the risk on. I'm a little reluctant to buy Apple stock myself because I think, well, it really hasn't sold off in a panicky way. And this could be a very standard pullback. And I don't see the fear in Apple stock. Let's go to the next slide. Tesla. I did this when it was at 550. I think it's at about 400 now. Again, $400 a share for Tesla. Very high. I mean, Tesla in a panic should be trading below 200. So I'd probably stay away from Tesla stock. I still think people are still betting on some of the euphoria here. And again, very rational pullback from way excesses to a number that frankly is still too high. So Apple and Tesla, these kind of, story stocks, momentum stocks, aren't showing that fear that you would have thought would be in place here. Let's go to the next slide. WTI oil. All right, 24 bucks a barrel. Let's look just at this slide, and where was it in early 2016? Well, during the spiky period down about this level. So again, as crazy as oil prices have been, if you look at levels going back 5 years, we've been here before. And they bounce back to 47, 40, 50 bucks a barrel. So again, people leaving price forecasts in the 50s for oil in a year, like you see that dotted line, sure, why not? This doesn't have to be the case that everything falls apart, folks. Again, very rational market in the face of a steep downturn with the Saudis and the Russians fighting. All we're doing is pulling back to 2016 levels. Fascinating, because you wouldn't have expected me to be so calm and sanguine. But when I'm just looking at facts in the marketplace, that's what I'm seeing and that's what I'm talking to. Next one. ISM manufacturing, last 5 years. All right, so again, what you're going to see is the ISM manufacturing was in the 60s and doing really well for 2018, and it's plunged since then. But we're back to 50, which is not a retraction. I mean, 50, it means you're just kind of steady. So the trade war didn't buy us anything, but it didn't hurt us really either. I think one of the things about the political policy discussions in the country right now is they get so divisive, and there's some truth in both sides. But again, just looking at the facts, the trade war didn't buy anything, but it didn't hurt you that bad. So the manufacturing in the United States is just ambling along. It's 15% of the economy. It's not helping you at all. It's certainly going to hurt for this period. You just look at the railroads this morning. They're all pretty low, but not as low as you'd think. Showing you that, yes, in fact, China is back online, and there are inputs coming into the country, and they're basically ambling through this. Next slide. Aluminum, copper, nickel. Again, we're seeing a lot of the plunging here. Look at copper. But again, copper is back to 2018 levels. It's not even back to 2016 and 17 levels. Same is true for aluminum, and the entire nickel, frankly, is still pretty high. So the point I want to make out of actual specific markets, they've been cooling from the trade war since mid-2018. And yes, they're signaling recession, but not so strong as you would think. And I think that's the real message I want to make here is either we got a lot more to go in terms of these signals signing off, or frankly, this pullback is far more rational than any of us want to believe. Next slide. Housing market, last 5 years. Okay. Big point to want to point out is people started to put their houses for sale in 2018, but then they stopped. And people started to really build strongly at the end of 2019. And sales have been basically rising quite dramatically the last 2 years. Now, we just got recent data out, this is cool. But again, it's cool from a fairly high level. And interest rates have fallen dramatically, got a lot of refinancing going. One has to expect this to, not this next 3 months, but in the summer, this is one of the spots where people could start to get interested because rates are going to be extremely low. And you have to figure some house buying could get going. So again, here I don't see, just look at this. Medium sales prices are kind of been down for a year. So people are, getting irrational. And they're starting to build a lot of them. First time we're getting 1.6 million starts from 1.2. That's good. So obviously it's all going to change, but the setting is, again, of a market that doesn't strike me as a huge source of weakness, only something that's going to completely be sidelined for 3 months. But in the summer and into the fall, it might be a source of strength. Next slide. All right, Treasury yield curve. Yeah, of course, this is down the really low ones, below 1 now. What I want to point out is just how tight things got before 06, 07-ish, and how tight they got in 2000. And it took basically 2 years for this thing to get rolling. I personally look at this, not at the levels, but at the compression of the yields curves, and think in many ways the yield inversion that's already happened. For example, my own asset allocation, I've been overweight cash for 7 or 8 months. Tim Nyland spoke to you all about his worries about recession months ago. So I think hopefully you heard that message. And yes, this coronavirus was a shock, but the recession that we're going to have should not have been a shock for any of us, because this clearly was being in place. It was in place long enough, year and a half, so that this is the typical signal, and it did work again. very heterodox way it worked. But the good news is people should have been preparing for a recession anyways. And I think that's true for the business community. They certainly didn't overbuy CapEx. And that's the good news. So I'm going to hand it over to Sheraz now. But I want to point out that basically things aren't so bad. And keep that in mind. That's not the message you expected me to hear. And I'll finish up with the JP Morgan Global PMI and the Treasury. They're the same thing, right? Treasury is going to go up. The PMI goes up for the JP Morgan Global Manufacturing PMI. And again, that's a global thing. I don't expect it to turn around, but 48 prints, folks, there's not a terrible number. You're looking for a 35, 38, and that's not what we see here. So again, either it's going to get a whole lot worse, or this market, even to now, isn't as crazy as you might have thought I was going to tell you. So I'll finish up with that, but the basic point I want to leave with Sheraz, with you, with everybody is this is what the picture is, the V-shaped world recovery. Yeah, so pandemic looks crazy, really down, really back up again. March and February didn't look so good either. So I think the good news is we have enough strong companies. We have a plan with this public health thing that has been executed, albeit a few weeks late, but that's not the end of the world. And we're doing the right things. So I think when you just stay with the facts of the financial market and use the language that I did to describe those facts, you find out it's rational and not that crazy. So that's the good news. Now, here's the bad news. American Hospital Association, epidemic wave for the next 2 months. The big thing I want to point out is 480,000 deaths and 1 million ventilators. So obviously we can't get there. We can get there, but that's why we shut everything down, because we don't want to overload the health system with 480,000 deaths and the need for 2 million ICU units. This type of stuff is why everybody shut down. Hopefully it works. If it doesn't, history is in the making, and we're going to learn some very terrible lessons. But keep this in mind. This is only a very severe scenario. It's driven out of the 1918 period. And when you see those big spikes and then the big flattening of the curve, remember that most of that was drawn from the 1918 period. Philadelphia was where we get that big spike. That was when they had a parade. They didn't tell everybody to stay home. And the long flattening of the curve is basically St. Louis. It did keep people home. But what I can only tell you is that if you actually look at the experiences of St. Louis and Philadelphia, St. Louis did keep flatten the curve, but they also pushed the bump out another month or two. So be ready for this thing to drag out till July, in my opinion. So here, again, numbers that I'm going to throw out for you. Got a long ways to go. Here's the unemployment benefits. Let's go to the last slide. Silver linings. I'll let you guys take a look through all this. But again, the faster we all shut down, the faster we get to reopening. Grocery stores are doing great. A lot of tech-based companies in the United States, and South Korea is showing us the way to do this. And we have the test response capabilities, Roche, Cleveland Clinic, Fujifilm, getting and put in place. So hopefully we've done the right things, folks. I hate to sound too optimistic, but I think when I just use these ERS slides and keep up to date with just using ZRS, everybody, you're going to find out that things are far more rational than you thought you were going to hear from me today. With that, I'll hang it over to Sheraz.
Before we bring Sheraz in, John, I just want to clarify. So is what I'm hearing from you in your optimism, you're not calling this officially a bear market?
Oh, it's a bear market, Terry, for sure. It's already a bear market by definition.
Okay. And what about the dollar strength?
The bear market has happened many times before, and this is not any more worse than the other ones.
And what about the dollar strength? Is that a negative here, especially in light of central bank action around the world?
No, basically the interest arbitrage between countries is basically keeping that out of the way. It is moving, obviously. Stronger dollars coming back, but not in a way that matters. I wouldn't worry about the strong dollar.
Okay, Sheraz, now let's bring you in here with your lay of the land on the earnings front. Originally the outlook was for positive earnings growth this year. Is that possibility wiped out now?
It's clearly wiped out, as you could see from this slide, Terry. And what I have here is the kind of stepping back from this March quarter estimates and taking a look at the quarterly earnings and revenue growth picture. The green bars are showing earnings, the orange ones are revenues. The highlighted in the box is Q1 and Q2, and as you could see, the green bars are both negative. So the answer to Terry's question, we still have growth expected in the back half of the year. Estimates for these first two quarters, the first half of the year, have come down quite sharply and essentially eliminated all their growth for the back half. But as John was explaining, and as I'm of the opinion, and I touched on this in my weekly earnings trends report as well, which I published yesterday and is on ZRS. There's a lot of uncertainty about the overall earnings picture, not just with us as analysts of the economic and earnings landscape, but also with the business owners and company managements. And it's unclear to them how the operating landscape will evolve, and that in turn is a function of how effective these measures that the government has put in place turn out to be. There is a best case scenario, there is a worst case scenario. You guys have all heard about that, but we don't know how the picture evolves. Let's just go to the next slide. And so here we're doing the same, but stepping further back and showing you the picture on an annual basis. So you could see 2020 is still positive. There's a 3% growth, as we showed earlier on the quarterly basis. All of that is in the back half. But look beyond 2020. There's a lot of optimism still, and a lot of that is basically unchanged from since this shock hit the system. Analysts and businesses simply haven't really come to grips with the full impact of this outbreak. So. As I mentioned in the earnings trends report yesterday, there's a lot of uncertainty about this outlook, and that's partly showing up in the day-to-day volatility in the market. What is the appropriate multiple for a market where you don't have a high level of confidence or a high enough level of confidence about the bottom lines? So let's go to the next slide. And the issue on the earnings front, as you see over here, what we are showing here is how estimates for the March quarter will rise down, and it looks quite ominous. But I'll tell you that this revision trend, despite all of the unique circumstances that the country and the business world has been dealing with over the last few weeks, this negative revision trend is only modestly above the magnitude of declines that we saw in the comparable periods for the preceding 4 quarters. So as we saw earlier, growth in the first half of the year has evaporated, and a big chunk of these negative revisions have arrived in recent weeks, but there's a whole level of uncertainty that everyone is trying to come to grips with. So let's go to the next slide. And in here, what we are trying to do is to give you a sense of how to look at the Q1 revisions trend that we saw in the preceding slide. Practically all sectors experience negative revisions. The sectors with the biggest estimate cuts are no surprise: energy, autos, aerospace, basic materials, industrial products. And the outlook for all of these areas still remains on the decelerating trend. John shared a chart for WTI, and that's the story for energy. Aerospace is a Boeing story. Materials and industrials are the classic cyclicals. Utilities has a modest uptick in estimates. I won't read too much into it. Finance estimates have come down, but the full extent of the Fed's rate cut bazooka hasn't really caught on with estimates yet. So there's more to come, in my judgment, because the rate cuts that the Fed has implemented has a direct bearing, particularly for banks, to their margins. And the one thing, the second last bullet that we have on this slide, the reason why estimates haven't really come down as much, we mentioned earlier that the Q1 estimates have come down, but they're just modestly above the preceding 4-quarter average. And the reason for that is that companies are as much clueless about the extent of the hit to their businesses as we as analysts are. So many of them, those that had publicly issued guidance ahead of this outbreak, have simply withdrawn it, and we can name the companies. And as I mentioned here in the last bullet point, my sense is that once companies close the books on March 31st and they come to grips with their numbers, we will have an above average level, an above average level of busyness this pre-announcement season. So a lot more companies likely, in my judgment, will pre-announce lower numbers ahead of their official quarterly releases. Let's go to the next slide. And here is a detailed summary look for Q1. And so what we have done here is there is comparison. The first two columns is the comparison of Q1 20 versus the preceding quarter, which was the fourth quarter of 2019. The first two columns are for earnings, the second two are for revenues, and then the third are for margins. As you could see, autos 40.9% decline. Energy is only 10% decline here. But my sense is that the analysts are simply finding it hard to market their earnings models to the very fast evolving oil price environment. In the aerospace is down 31.2%, conglomerates 10.3%. And across the board, you could see that a lot of negatives. Transportation 11.4%, I think, is in the same boat as some of the other areas, particularly on the air carrier side. they'll get a better handle on their numbers once they close the books. So 1.7% decline expected for the March quarter. We had essentially a flat showing in the fourth quarter. The revenue growth picture has been pretty good in recent quarters. 4.1% expected in Q1. It was 4.2% in the last quarter of 2019. And the margin picture remains challenging. As we look ahead to the remainder of the year, the margin picture will remain challenging for many of these companies. Payroll remains the biggest line item in the P&Ls for all of these S&P 500 companies, and they have to grapple with the question of whether they lay off, whether they furlough, and all of those decisions will have consequences for margins. So even in a best case scenario where the top lines don't shift a whole lot, there'll be a margin hit, and that'll show up. So if we go to the next slide, and I'm coming to the practically to the end of my presentation here. So the energy, materials, aerospace, finance, autos, industrials, transportations, as you saw on the preceding slide, are big decliners. Finance, as we mentioned earlier, has suffered some estimate cuts, but not to the extent of the dislocation to their margins. Tech outlook has improved. Tech was a drag on the index throughout 2019. Semiconductors were a big drag last year. They still remain a drag in Q1, but a lot less than what we experienced in 2019. So as the semi drag fades in 2020, the overall growth picture for the tech sector improves. Semis bring in about a sixth of the tech sector's total earnings. Transportation, as we understand, clearly is a victim of this shock to the system. Retail has both winners and losers. We saw with Costco's numbers how this shock has been a boon to their comps, but many others. Our retail sector has the department stores that were struggling already and had a bunch of zombie operators. Restaurants also fall in our retail, and those companies are suffering and are likely to be big losers. The aerospace weakness is essentially a BA issue. Boeing has the legacy issue of the 737 MAX, and then its biggest end market, which is the commercial aviation, has been hit hard directly. So if we, and I'm looking at the second last bullet here, when we try to contemplate the earnings picture going forward to make sense of this market, you try to have an outlook on two key metrics. One is the top line, the second is margins, and then that gives you the bottom line. Revenues, or the top line for these large caps, and we're talking here about the S&P 500 companies. When you plot the S&P 500 revenues, which is a nominal number, and you plot it against nominal global GDP growth, it plots very nicely, essentially on a one-for-one, the movement over a long run. Very strong correlation, as we would understand. So as you are sizing up the outlook for revenues, you have to take into account all the points that John Blank was explaining to us earlier. with respect to the broader economy. So the outlook for revenue will be a function of the outlook for GDP. The specific here is the nominal GDP for the S&P 500 companies, but with been a lot of inflation in the global system, there's not a whole bunch of difference between nominal and real in any case. So the hit that the US and the global economy suffers as a result of this outbreak will have direct implications for top lines for these companies. We briefly touched on the margin question of how payrolls and many other line items management teams have to contemplate as to how they respond. And that will determine margins. John Blank showed earlier how margins are at all-time record levels, so there is room for those to come down and still remain pretty robust. And the last bullet point, we're all working remotely currently. It's a new experience for all of us. And my sense is that in mid-April, as the big banks start reporting results, it'll be a unique experience for all of us. So we will have the reporting season in the midst of this pandemic-driven lockdown, which will be quite unique.
Sheraz,
go ahead.
I just wanted to jump in here a little bit more on the timing of the Q1 reporting season. Given the timing of the effect of the pandemic on these corporations, are we going to need more lag time before we see their earnings reaction, or is it going to begin to show up in the next season?
Yeah, so my sense is that that once these companies close the books on March 31st, then they have a pretty good sense of what their March quarter numbers look like. And to the extent that there is a huge gap between where the market is in terms of consensus estimates and the numbers that the CFO and CEO is looking at internally, there will be all the incentive, particularly in a market which is already in a very weak state. So that's the reason why I was mentioning earlier that we will have an unusually busy pre-announcement season post March 31st, with a number of these companies, their businesses and also their markets severely getting impacted by the outbreak in March, and they'll have a better sense of the numbers. And my sense is that they'll have all the incentive to share those numbers with us, and that's when the estimates catch up with the ground reality, even before the actual numbers come out in their quarterly releases.
And John provided us with a little bit of optimistic guidance, telling investors now's the time to buy stocks. From the earnings point of view, though, how do you think investors might navigate this landscape, especially those investors who rely on earnings reports to base their investment decisions?
My sense, that's the million-dollar question, Terry. And my sense is that there's a lot of uncertainty, and a big reason for that is how effective or otherwise the measures that the government has put in place or is advising the country to implement turn out to be. So what I've read, and I'm sure our audience is well aware of that as well, the best case scenario is a late April, early May kind of peak for the pandemic. And we kind of start start decelerating from that point onwards, with the entire thing getting flushed out in a late summer type of a time frame now, positively for us, and as John emphasized in his outlook, we got into this shock in pretty good health. Whether you're looking at the corporate sector or you're looking at households, financials were in good shape. We were looking ahead to a positive earnings year, as you pointed out at the upfront, and balance sheets were in pretty good shape too. The labor market extremely strong as we are now. So, assuming that this best case scenario unfolds on the outbreak, then we have a Q3 bounce back in economic activities and business activities, and we accelerate into the last quarter of the year, and in 2021 is a very strong year. So I'm not as optimistic as John Blank is, but I see where his optimism is coming from. And part of my lack of optimism is the weaknesses that we carried into this downturn, and the weaknesses were on the manufacturing side. John showed us that the ISM, the PMIs were at 50, and had been kind of a drag over the past year and a half. The farm sector was struggling, and so these two key areas, admittedly not huge chunks of the economy, but those two key areas were in pain getting into this, and that pain gets exacerbated now to the extent that these measures in mitigating the outbreak are successful, and we have good support from the federal fiscal side and from the monetary side. I think the economy should be in a good shape to absorb the shock and come out in decent shape at the other end, which should give us confidence in estimates for 2021 and 22. But a lot of that, as I say, is a function of how the outbreak unfolds, and that's hard for any of us to model at this stage.
Yeah, I apologize for interrupting you. Do you have any more for us in your presentation?
No, that's the bulk of I had for earnings. Yeah.
All right. Well, information from both you and John, certainly very informative and very interesting, to say the least. But with that, we'll have to wrap up another call. Thanks again to our panelists, John Blank and Sheraz Mian. We hope you found it informative. If you have any questions regarding our services, feel free to email them to zrs@zacks.com. And also, if you would like copies of John's or Sheraz's PowerPoint presentations featured in today's call, same email applies, zrs@zacks.com. You can contact your ZRS representative directly or access these slides in the GoToWebinar console. In the meantime, on a side note, we hope that everyone out there is doing as well as they can during this very challenging time. I know everyone here at Zacks is doing what they can to service each of you during this time, as even though they're working remotely, they're still putting a lot of effort into providing you what you need. So we appreciate your understanding, and we thank you for that. Meantime, thanks for joining us today. Feedback always welcome. In fact, after you close out of the webinar, you'll be prompted to fill out about a minute survey. We'd appreciate if you would do that, because we'll use those comments to improve on the quality and content of future calls. And with that, we'll all look forward to being together again next time on the call.